Hi, how are you doing? So today I will take you through IPSAS 42 social benefits. So what we will look at how a public entity, how a public entity, yes, how a public entity accounts for cash transfers that protect people from social risk. So what is IPSAS or what is it about? What is this IPSAS about? So here you will find, for example, governments hand cash to people. So governments hands cash to people who face the hard times of life. For example, someone is on in old age, disability, sickness, unemployment, the loss of a breadwinner, situations like that. So these payments are called social benefits, and they are some of the largest sums government entities pay. IPSAS 42 now sets out how the entity pays them, records the cost and the amount it owes. So what we'll be talking about is social benefits. And these social benefits answers just two questions. It answers just two questions. When does an expense, when does a social benefit become an expense and a liability? When does it become an expense and liability? And how much do we put in our books? The whole standard turns on a single idea about timing. So the time, what matters is the time. So we have learned in other IPSASs and this IPSAS. For example, the closest IPSAS to this is IPSAS 39, employees benefits. So the employees benefits and social benefits, are they related? That's some of the questions people ask themselves. So what's this big idea I'm talking about? Recognize an expense and a liability only for the next payment, only for the next payments. So it's not talking about 50 years, 20 years, 30 years, like employees, the way we normally do, the defined contribution plan and defined benefit plan. This one you will be talking about, or gratuity. This one will be talking about the next payment. And then whose eligibility criteria a person has already met. So there is an eligibility criteria that someone must meet before they meet for before they qualify for these social benefits. So do not put the whole stream, like do not capture the future payments, the whole future payments, except the next payments on the books. The future payments are not yet owed. I will explain this. IPSAS 42 has this IPSAS has no IFRS equivalent, no IFRS equivalent in the private sector. So IPSAS is International Public Sector Accounting Standards, IFRS is International Financial Reporting Standards, IS is International Accounting Standards. So there is no IFRS equivalent. It is only for the public sector, like the one for the budget, IPSAS 24. So take care to keep it apart from IPSAS 39, because many people confuse with IPSAS 39, which covers benefits paid to government employees. So this one is different from what we pay, the severance package, the benefits, the long-term benefits after employment and others. So a social benefit goes to citizens because of a social risk. So it is curing a problem, a social risk, not to staff because of the services they offer to us. So there are key terms we look at: social benefits. What is this social benefit? Social benefit is a cash transfer to specific people who meet the eligibility criteria. So those, for example, those who are 70 years and above. Then social risk, an event tied to a person like age, health, poverty, employment that harms their welfare, like old age. When I grow old, so I want to be paid a certain sum. So it caters for certain risks within our society. Eligibility criteria. There must be conditions a person must meet. In Kenya, we say a person over 70 years who is a resident, alive, and registered. Alive, not a person who already kicked the packet or who left us. So the scheme, the program through which the benefit is paid is the scheme. So the old person cash transfer, here we have OPCT, old person cash transfer. So there must be someone must meet that eligibility criteria. So I will give an example. This is an example. In this example, you will see here is an example. Whom are we paying? We are paying citizens aged 70 and above who are residents alive and registered on the scheme. How much? Per month, we are paying them 2,000. In Kenya, we normally estimate them for like 500,000 people who are eligible. When is it paid? On 5th. Like, it's like you are running salary. So salary, you work between 1st to 30th, for example, and we pay you 5th every month or 29th every month. So we pay you after earning the service, after completing the service. Again, for them to qualify, they must have lived for the previous month, like from 31 to 30th January or 30th, 31st December. They must have been alive, have been at the age of this, have been a resident in this country. That is the past. When we normally pay is when we pay 1 month later. Then funding paid from tax revenue. So this kind of services, social benefits, can either be paid from two sources: tax or insurance. Tax or insurance, and both can be accounted the same way or different. So funding paid through tax. Then reporting date. If your country reporting date is 31st December, then you look at 31st December. So if you normally pay 5th of January, and your reporting date closes on that first, what happens? You debit the expense, the social benefit expense, and credit social benefit liability, social benefit liability. So once you pay, then you reverse. You say credit the liability and debit debit the liability and credit the bank. Credit the bank and debit the liability. When you are reducing a liability, you debit. When you are reducing your asset, you you credit that asset. So the next one is, we have that example. Now we will take through these steps. But before I go to those steps, we look at the scope, how this IPSAS works. The scope, what is covered inside this IPSAS. Is the payment a social benefit? So we look at it. Is it a social benefit? If no, then we cover under another IPSAS. When is it owed? When is it owed? Have the criteria been met? And then how much? What is the best estimate? Like the money that we normally pay. Stage 1, let us start with stage 1. Is the grant a social benefit? That's the question we are asking ourselves. So how do we know if something is a social benefit? We look at 3 criteria. Criteria number 1, we ask ourselves, is it a cash transfer to a specific individual or households? If the answer is yes, then you move to the next one. Does it is a social risk? Like this cash transfer, is it easing a social risk? Old age, disability, unemployment, or something like that, or health, something like that. Is it easing a social risk? And then, is it addressing the need of a society? Like that social risk, is it within our society? If the answer is yes, then you move to the next stage. You ask yourself, if the answer is yes, you move to the, but if the answer is no, then it fails. It falls outside the scope of IPSAS 42. These are some of the examples that fall outside the scope of IPSAS 42. A pension paid to retired civil servants. This is outside the scope of IPSAS 42. Where does it fall? It is pay for past service, not a social risk. So it falls under IPSAS 39. Free vaccination for every child. It's a service, not a cash transfer. It's under IPSAS 19. Cash relief after a regional flood. This is a risk to geography, not a personal characteristic. So it falls outside the scope of IPSAS 42. A true insurance contract. It falls under insurance scope. So it's an exclusion. The insurance accounting applies, which is IFRS 17. Initially it was 4. Currently, the IFRS that applies is IFRS 17. So the next question is, with our example we have given, the 500,000 people who are 70 years and above, who are, say, we are paying them every month 2,000. When can this grant become a liability in our books? When does this grant become a liability? So the past events that creates the liability is the moment a person satisfies all the eligibility criteria for the next payment. At that point, the entity has a present obligation. So it recognizes a liability. When you satisfy all the criteria we mentioned above, like the old age, the resident who was alive at the previous month, then it becomes a liability. Then what happens? The 2,000, if we multiply by 500,000, that's 1 billion. So we debit the social benefit expense. And credit the social benefit payable in our books. That is 500,000 we multiply by 2,000. When the cash goes out, say on the next month, when you pay after the reporting date, when you pay, you debit the liability, you reduce the liability, and now also reduce your cash. So you extinguish the liability from your books. We normally say, when you are increasing an asset, you debit that asset. When you are decreasing that asset, we credit that asset. The same applies. When you are increasing a liability, we credit. And then we do the reverse. We debit. But then there is a trap in this IPSAS. The trap is, however, like under IPSAS 39, we were providing the provision for the subsequent months, years, like 10 years, 20 years. Now, this is the trap. The eligibility criteria says someone must have lived for the past years, past month. Someone must be over this age, must be alive, resident. But then, what's the surety that the criteria will be met in the next few years, in the coming month, in the subsequent month? So what happens is, this one, the only trap is, we will only look at the person who has fulfilled the criteria for this month or for the previous month. We only look at the next payment. We don't look at the coming years. So here is where many of us go wrong. The liability covers the next payment alone. So the liability covers the next. It does not cover the long stream of payments a person may receive. Unlike IPSAS 39, those future payments depend on the person staying alive and eligible, which are future payments. So there is no present obligation for them. So this is a sharp line between IPSAS 42 and IPSAS 39. An employee defined benefit puts the whole future obligation on the books, while a social benefit only puts the next payment. So a good test to carry into the question is, do not ask how long the person may receive the benefit. You ask yourself whether they have met the criteria for the next payment. So out of the 500,000 people we mentioned, the 400,000 might again qualify, or the 600,000 might qualify. So this one depends on someone meeting the criteria. We don't look at the future payment. You only look at the next payment. So stage 3, we ask ourselves, how much is the liability? Measure the liability at the best estimate. We already know these numbers at the best estimate. If you cannot reliably measure, You don't put in our books of the payment the entity will make to settle the present obligation, which is the next payment. So most social benefits are paid within a month. Within a month. So the liability is always short term. But suppose it is something you pay after 2-3 years, IPSAS tells us we discount since it's a future payment. But then if it is within the next 12 months, you don't discount. If the amount is not so material and it isn't within the next 12 months, then you don't discount. But if it is more than 1 year and it's material, then you discount. Discount only when the next payment is material and more than 12 months. So when the payment period straddles the reporting date, sometimes like it can fall between say January 15 and December 15, December, January 15. So you apportion. You say the 15 days out of 31 days time is the 2000, which is 1032. So you apportion. That's what IPSAS tells us. When sometimes a payment covers a period that crosses the year end. Suppose the grant of 2000 paid on 15th January is for the month from 16th December to January 15. At the end, at 31st December only, only part of that period has passed, 16 days of 31 days. The entity recognizes a portion, so this is 16 days, a portion for which the eligibility criteria have been satisfied by the reporting date, about 1032 a person, and weighs the chance at that some people cease to be eligible before the payment is due. So you apportion. So this is accrual concept. You only recognize what was incurred. So paying before the criteria is met. If an entity, suppose we pay before the criteria is met, again, you recognize an asset because you paid in advance. You recognize an asset. So you debit prepaid social benefit. In this case, if an entity pays grant before the person has met the criteria, suppose say the department pays January grant early on December 28 before anyone has lived through January 31st. At first, this payment is a prepaid expense. So after recognition, when eligibility ends, then we recognize the expense. So we credit the asset and debit the expense. That's how you reverse. The insurance approach. So this is an option. Some schemes are not paid from general tax. So they are funded by contributions from members, managed so that the contributions are meant to cover the benefits in full, like an insurance pool. For a scheme that is intended to be fully funded from contributions and is managed by that way, the entity may, this is optional, may choose to use the insurance approach because this is another pool. It's funded from insurance and accounted. So this you account for under IFRS 17, as I've already said. What do we then disclose? The notes explain the scheme the entity runs, who they cover, the benefits, and the eligibility criteria. That's what we record under the notes. They explain the demographic, the economic, and the outside factors that could change the cost, such as aging population. Where a scheme is funded by contributions, the notes should cross-reference, should refer to the information about those contributions. So this standard is very simple. It only looks very simple. So what it tells us, don't think about IPSAS 39. This is social benefits, not employees' benefits. You only look at the next payment. You only record once the person fulfills the criteria. So there are common mistakes we normally make. Mistake number 1, putting the whole future stream of payments in the books. Like you say, the whole, this person is 70 years. So you account for until this person, say, you estimate and say this a person can live 100 years. So you record the whole 30 years in your books. That's wrong. So recognize only the next payment whose criteria has been met. Recording a civil servant pension year. No, this one. We are wrong. This is covered under IPSAS 39. Expensing a grant paid before the criteria is met. So don't expense. If you pay something in advance, this is accrual. What do? You record an expense. You record as an asset in your books. Discounting every liability. You don't discount every liability. If it is material, there are two conditions. And the period you are paying is more than 12 months. Discount only if the next payment is over 12 months or material. Calling a free public service a social benefit. That's also wrong. A service is not a cash transfer, so it falls under IPSAS 19 and not IPSAS 12. So thank you for watching this video, and if you like what I'm doing, please subscribe to my channel and welcome.